stop whatever you're doing and listen, because this isn't a mild market rumor or another guess from someone chasing clicks. This is a full-on alarm bell. Silver price is gearing up to break records. And when I say break records, I don't mean a small new high. I mean a dramatic, headline-making revaluation that shocks markets, changes portfolios, and forces governments to take notice. Why am I so confident? Because the evidence is everywhere if you know how to read it. This is not a story that begins with a single tweet or a random analyst. It's a story of converging forces. Macroeconomic stress, industrial demand accelerating, supply constraints that won't be solved overnight, and institutional behavior that's quietly shifting in favor of hard assets. Put them together and you've got the perfect pressure cooker for silver. Let's start with the basics. What makes silver different right now? Silver is unique because it is both a monetary metal and an industrial metal. Gold has always been the go-to for central banks and long-term stores of value. Silver plays a dual role. It's used in solar panels, electric vehicles, 5G and semiconductor manufacturing, medical devices, and countless uses in green technology. As the world electrifies and decarbonizes, physical demand for silver is surging. And that demand is sticky. Factories don't pause production because the price of silver ticked up 10%. They buy what they need. Now couple that with monetary stress. Central banks have expanded balance sheets massively over the past decade, and governments have piled on unprecedented amounts of debt. At the same time, political and geopolitical instability is rising. Those are the conditions under which people and institutions seek refuge in things that can't be printed. Physical metals. We've seen gold rally. Silver is the metal that historically magnifies gold's moves, sometimes wildly so. Here's a hard fact. The gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, currently sits at extreme levels compared to historical norms. Over long stretches of history, the ratio averages roughly 15 to 16 to 1. Today, it's far higher. In plain terms, silver is historically cheap relative to gold. If that ratio normalizes, silver's upside is enormous. But ratios and macro narratives only matter if the physical market can't catch up. And that's where the real urgency lies. For years, global silver demand has outpaced mine supply. A large portion of silver production is a byproduct of other mining operations. Copper, lead, zinc, meaning silver supply doesn't respond quickly to price signals. You can't flick a switch and double silver production overnight. New primary silver mines require massive capital, environmental approvals, and years, often decades, to come online. So when demand surges, and it is surging, price must move to equilibrate the market. Next, consider inventories. Exchange inventories, the silver sitting in COMEX and LBMA vaults, have been ticking lower. Registered supply, the metal available to settle contracts, is painfully thin in certain pockets. Meanwhile, premiums on physical bullion and coins have spiked during even modest surges in interest. That tells you one thing: when the paper price and the demand for physical metal disconnect, the physical market will force a repricing that the paper market cannot ignore. Then there's the Industrial Revolution: solar adoption, electrification, EV production, 5G hardware, and semiconductor expansion. Governments pushing green energy and electric transitions don't care about near-term price pain. They need the inputs. Silver is essential in photovoltaics and other renewable tech. Forecasts show rising industrial demand for the next decade. Not a temporary blip, but a structural shift. Okay, so fundamentals look scary bullish. But what about institutions? This is the subtle, dangerous part for those late to the party. Institutions move quietly. Central banks, sovereign wealth funds, and large asset managers don't shout every trade from the rooftops. They accumulate positions stealthily through proxies, ETFs derivatives, and OTC purchases. Over the last several years, we have seen a marked increase in institutional interest in hard assets. Gold has been the headline. Silver is becoming the stealth play. When institutions decide the risk-reward favors silver, they can create enormous demand quietly. And then the public wakes up and the squeeze becomes explosive. Now imagine all these forces hitting at once. Inflation that stays stubborn, a new spike in energy prices, a geopolitical crisis that reroutes trade, a sudden factory ramp in solar manufacturing, dwindling exchange inventories, and increasing institutional accumulation. That's not a slow grind. That's a shock event, a manic, panic-driven eruption in price as buyers chase limited supply. Let me walk you through plausible price dynamics. If the gold price continues to make new highs, silver historically overreacts on the upside. That means even a modest further rise in gold, combined with the normalization of the gold/silver ratio toward historical averages, could push silver into triple digits. Yes, triple digits. And if industrial shortages and central bank purchases converge, we're looking at price levels that most analysts treat as fantasy today. But it's not just about fantasy, it's about math. Think of the current above-ground stockpile of silver as a finite reservoir. Once industrial demand and investor demand exceed mine production plus available inventories, the only mechanism to clear the market is price. Higher prices incentivize substitution and recycling, but that takes time. So the initial shock is price-driven, and it can be violent. So what should an investor or someone protecting wealth think about doing today? First, physical possession matters. Owning allocated physical silver, coins or bars securely stored, gives you a claim on actual metal, not paper promises. During a physical squeeze, premiums and delivery times can blow out. If you own physical metal already, you avoid the scramble. Second, diversify how you own silver. Have a core position in physical metal. Consider reputable ETFs for liquidity, and consider carefully chosen silver miners for leverage. Mining stocks are volatile, but when silver explodes, quality miners can deliver 3 times, 5 times, or 10 times moves. Third, be strategic about premiums and timing. Buy gradually, dollar cost average, but be prepared to act faster than you think. If you wait for confirmation of the breakout in headlines, you will almost certainly buy at a higher price. And a quick word on risk. Silver is volatile. The path to record highs will be punctuated by violent corrections. This is not a smooth ride, but we're talking about asymmetric payoff here. Limited downside relative to potential outsized upside if you position prudently. Now let's address the skeptics. The people who say, this is a bubble talk. Silver won't break records because markets are efficient. 2 things. Markets are efficient until they aren't, and the market's efficiency is tested primarily in extreme events. Paper markets can mask physical realities for a while, but they cannot hide structural deficits indefinitely. When the physical market reasserts itself, corrections are abrupt and often painful for the complacent. One last point that most people underestimate: policy reaction. Central banks and governments will react, and not necessarily in ways that calm the market. When silver spikes, you can expect sudden regulatory chatter, export controls, and maybe some market interventions in the short term. That can amplify volatility, but those actions rarely change the structural reality. When production is limited and demand is exploding, price must reflect that. So what does all of this mean in one sentence? It means the setup for silver to break records is laid out in plain sight. Structural demand growth, constrained supply response, thin inventories, rising institutional interest, and macroeconomic vulnerabilities that favor hard assets. All the ingredient signals are aligned, and when they converge, price action won't be polite. If you're watching this as a casual investor, I'll leave you with a clear checklist. 1. Secure a baseline physical position, coins or bars you own outright. 2. Allocate a portion of your portfolio to quality silver miners for leveraged exposure. 3. Keep some liquidity to take advantage of price pullbacks or premium dislocations. 4. Avoid chasing headlines. Buy into the thesis, not the hype. 5. Prepare mentally for volatility. Strap in and plan your risk tolerances. We're standing at a pivotal moment where silver's historical role as both a commodity and a monetary asset is returning to the foreground. This is the kind of crossroad that makes fortunes and rewrites balance sheets. So here's the bottom line. Don't be surprised when the news cycles suddenly flip and everyone is talking about silver. The surprise will be how fast it happens. The writing is on the wall. Silver is poised to break records. Not because this is a pie-in-the-sky prediction, but because the supply and demand math and the macro backdrop all point that way. The opportunity is real, but so is the risk. Prepare wisely. Own real metal. Position intelligently. And when the bell rings, be ready to move. Because when silver breaks records, the window to act will be brief and brutal.